welcome to the Mutual Fund Show. Remember, SEBI has directed mutual fund houses to moderate flows into small and mid-cap schemes. This directive comes on the back of soaring valuation in the small and mid-cap stocks. This move is aimed at protecting investors from first-mover advantage of redemption in these funds. Well, it's a big development. We have seen some of these schemes actually skyrocket with over 10,800 crore rupees entering the small cap space in the last few months. Now, what does this mean for mutual fund investors going ahead? That's what we're going to be discussing. Muralidhar and Swaminathan also joined. Murali, just before we go over to Harshvardhan, a quick one on this, right? Advisors will always tell investors, you must rebalance your portfolio.
Right.
You've got to do it often enough because returns are a function of the markets, risk isn't. And the one thing investors need to control is risk. I think the good thing out of this is, or the silver lining really is, that the regulator is now telling you your mid-cap funds and small-cap funds have done exceptionally well.
Right.
They look expensive, there is fraud, and I think time and again, we've talked about this too, extensively, where large cap looks probably better valued or is fairly valued at this stage. So while I know the street has gotten nervous, but I think 24 hours in, the markets are also looking a little more settled at this stage as we see it.
Absolutely. So very important points here, Samina. The most important point is that the regulator has to step in. This is something the industry must have done on its own. Here you have a regulator coming in and telling the viewers, investors, that they need to be cautious. Absolutely, no doubt about that. But the bigger question, Samina, is about what does an investor do who is holding small and mid-cap funds? That's the big question we are going to ask today. And we are getting experts who will be able to talk to us. Why don't you introduce the guests to the investors?
We've got Harshvardhan Roongta, CFP, Roongta Securities, and Mohit Gang, co-founder and CEO of Moneyfront, joining in. Harshvardhan, afternoon. Thanks for joining in. I'm sure your phone hasn't stopped ringing since yesterday after the SEBI put out this advisory. What are you telling your clients? People are nervous, and I think we need to sort of, make sense of all this. As an investor, should one be concerned at this stage? What have you told your clients, and what are you going to be telling them?
So, well, Samina, when you're creating a portfolio, it's not about, talking about a scenario where inflows have come into small caps and mid caps, and then we're looking at it. So when you're designing a portfolio, at that point in time, an investor needs to very carefully do a risk assessment profiling done, which basically is aimed at understanding how much are you likely to be, able to, bear, deal with the volatility that comes with mid and small cap funds. So, how you design a portfolio becomes important. So such directives don't really change that narrative. Now, for example, our approach to portfolio creation has always been the core and satellite. So when we say there is a core portfolio that you create, where probably a 40 to 50% of your allocation has to be towards large caps. So that becomes the core portion of your portfolio. The balance 50% could be in mid and small caps or thematic or sector funds as an individual is comfortable with. Now, if you've undergone that exercise and you've designed your portfolio, such directives coming in to say that you please look into how your mid and small caps are doing, put in some kind of directives or policies in place which will try and protect the investor who's coming in without understanding, then it is primarily for that investor. So as far as we are concerned, there is no change in our portfolios, because at the time of designing the portfolios, we've been very careful in allocating only that much amount to mid and small caps, as much the investor can take. So we've not looked at, or our investors are not looking at only past performances and allocating towards mid and small caps. They've essentially done risk profiling on themselves, and then they are going out and allocating towards mid and small caps, which nothing has changed in that context as of today, only because of the directives.
Right. So balancing the portfolio, taking care of the risk is something you always tell. Advisors have been telling, the industry has been telling the investors. But then, at the same time, when there are situations, there are investors who have invested in small cap and mid cap. Let me take this question to Mohit. Mohit, what would you tell the investors at this stage? If somebody is invested in small cap, book profit, move on, or simply hold, or redeem or add, what would be your advice?
Thank you so much. I think as Harsh rightly mentioned, that the portfolio allocation, once done rightly, then you don't have a reason to tweak it or rebalance it or change it or alter it just because there has been a directive from the regulator on the markets, or because the markets have overran or markets have done exceedingly well, right? I think investors have allocated some amount of money in small cap and mid cap baskets only because they wanted extra returns and they were happy to take volatility in the first place, right? That was the whole premise of them investing into mid and small caps. Now that situation has turned out well for them for last 1 year, this is a time for them to reap the benefits of it and stay invested on the course, right? If you have decided to invest 20% in mid and small caps, please by all means continue that path. Don't overdo the allocation. I think one small piece of advice which we have been giving to all our clients is that if you have a portfolio of 20 rupees in small caps, by virtue of market movement, if it has run up to 25 odd rupees, then yes, by all means, you should take off the 5 rupees and rebalance it to some other market cap, or perhaps move it to some other asset class altogether. But if you are well within your portfolio limits, if you're well within your asset allocation, then there is absolutely no need to panic. Markets will go through bouts of correction. Markets will see these kind of phases, but investors need not panic, and they should just continue the process of building up their corpuses through systematic investments or whatever their process is. I think investors need to stay put with their allocations.
Mohit, that brings me to my next follow-up question, and you alluded to the fact that you've got to rebalance your portfolio either on an annual basis or if the exposure increases due to a market move. Have you already rebalanced your client portfolios?
We follow a fixed methodology on that. So every quarter or 6 months, depending on what kind of frequency we have mutually agreed with the clients, we follow a fixed process, and we also have some stepwise formulae. And the formula perhaps is 5% movement in the portfolio value or 5% movement in the assets value. And that is when we come to a table and discuss whether we need to rebalance, or in some cases, it could be 10% also. So let's say if the equity and debt allocation is 50-50, and by virtue of market movements the equity has moved on to 60, then we will have a fixed formula that okay, 60 is somewhere where we need to take a follow-up step on, and that could be then be mutually agreed depending on clients' liquidity, clients' preferences, what his risk appetite is, whether it continues to remain same, whether it changes with the market scenario or changes with his income dynamics. So keeping all that in consideration, if everything is status quo, then definitely yes, at a 5% or 10% movement, we will definitely go ahead and do some amount of rebalancing in the book.
So very clearly, this is not a situation where the investor has to panic. They have to rebalance. If there is excess profit, I'll use the word excess profit because a lot of valuations have run up over the last 3 months and 6 months. We can bring up the chart. We'll also get specific queries from the viewers. Viewers have been sending in queries. I'll ask my producers to bring up the queries. Harsh, let me come to you on this question. At this stage, should we very clearly move to a situation where, I'll say that should we move to a balance fund because the interest rate cycle is also turning. Forget equities. Should we move to balanced hybrid fund also?
Well, Murali, I will also want to touch upon one aspect when you say that we should remove money from small caps and rebalance. Okay, so I'll just answer that first and come to the balanced hybrid fund category. So, most of the investors that you meet, in person, and I've met lots of them in a couple of investor meets. Now, you will realize that most of these investors who are small cap investors have come into small caps purely seeing the returns that have been generated in the last 1 or 2 years. So they don't understand small cap as a category. If you ask them to name 5 companies in their small cap portfolio, they don't even know that. So very clearly, investors who have come into small caps and mid caps purely looking at past returns without doing a risk profiling on themselves, this is a great time to exit, okay? Because whatever mistakes you may have possibly made, you're getting an opportunity to rectify that at a profit. So if you, and because the small cap and mid cap indexes have run up exponentially, it's time that you can cut your mistakes and then redirect or rebalance your money into, say, probably large caps, because you're booking your profits and going to large caps. So I think it's a great time to take this directive into consideration and look at your portfolio risk profiling and make those changes. Now, coming to the question of hybrid funds. So, well, yes. So if you look at one element where we believe that interest rates in 2024 should ease out a little bit. Now, when they will happen, we don't really have an idea about that. But it looks favorable. The scenario looks favorable and suggesting that interest rates will come down in 2024 for sure. If not by a great amount, I mean, there will be some reduction in the interest rates. So debt has a potential to generate, make a capital gains on that kind of an interest rate reduction that happens. So yes, if you park your money into say short-term funds at this juncture, even if you don't go to the long-term, long duration fund, you go to short-term funds, I think it's a good allocation to make. Keeping in mind the growth element or the growth prospects of our country, you cannot get out of equities at this juncture. Though the valuations may look rich, though there could be concerns of, when you look at relative market comparisons to Asian countries, emerging markets or developed, yes, we are a bit expensive, but it is not wise to stay out of the Indian economy right now. So you cannot stay out of equity. So yes, there is merit in having a hybrid fund. It could be in the form of an aggressive hybrid fund, it could be a balance advantage fund. It could be equity savings,
Sure.
whatever. But you cannot stay out of equity for sure.
Yeah, okay. Harsh, we have a specific query coming from an investor. He's 28 years. Harshit, his age is 28. His goal is to invest in small cap funds. He has a lump sum investment of 1 lakh rupees and he is dividing it further as 30,000 rupees in large and mid cap funds, 40,000 rupees in flexi cap and 50,000 rupees each in mid and small cap funds. Is it a good time to invest now if the time horizon is 5 to 7 years given the predicted 20 to 30% correction in mid and small caps? I think he has done his homework. He is expecting a 20 to 30% correction. One of you could take this, Mohit or Harshvardhan. Who would you want to go?
Look, my thought has been very clear on these things. Honestly, this is not the best time. This is the second best time. The best time was yesterday. He should have done it yesterday and not today. He's already late in the getting in the market. 20-30% correction is honestly par for the course. If he's going through via an SIP route or a systematic investment route, then he need not fear any correction. If the correction at all comes in, he will buy more units and he will better deploy his funds. But if the correction doesn't come in, he will at least not be regretting 1 year down the line that he failed to invest waiting for a correction, which is what I'm seeing with a number of investors, that the time they are just time spent in waiting for a correction is far more doing far more damage to their portfolios and their returns than what possibly a correction could have done. So my wholehearted submission to all investors out there is, don't wait for an opportune time. SIP is an instrument which is meant to tackle volatility, which is meant to reduce volatility. So you better get into the markets today with whatever allocations you want to and keep going on with a systematic, disciplined process. I think that will fetch far greater returns and rewards than just waiting and timing the markets.
Right, Mohit. It's very rarely timing the market. It's usually time in the market that helps investors create significant wealth. And I think that's what's most important. It's a strategic portfolio as opposed to a tactical call that investors need to be taking. Harshvardhan, I'm going to bring your opinion on this one too. And I want you to give me a broader brush on what do you think about his query and what is the advice you have from him, and also if you can give us a sense of what you make of his holdings. He does a SIP in a Mirai Asset Mid Cap Fund, a Quant Small Cap Fund, Quant Mid Cap Fund, UTI Nifty Index Fund, and HDFC BAF, SPI BAF, Nippon Small Cap Fund, Parag Parikh Flexi Cap, Mirai Asset. I think to begin with, and Harshvardhan, you'd agree with me, if you own the market, you can't outperform the market. So firstly, I would recommend consolidating that portfolio, but I'll leave it to you to advise our viewer.
Absolutely. So, Samina, you're absolutely right, because see, the first observation that I have in this portfolio is that there are too many schemes in the portfolio. So I don't know the amount, the quantum that is investing in each scheme, but there are about 2 or 3 mid caps, there are 2 small caps. So I think how an investor should go about doing things. To begin with, say you have 100 rupees to invest, and that is your equity allocation. I'm not talking about debt. So if your 100 rupees is supposedly an equity allocation, you need to ask yourself, how much would you want to invest in each market category? So you're going to say that I'm going to invest, say, 40 rupees in large caps, probably another 30, 40 rupees in mid cap, and the balance in small caps or thematic sector, whatever. So first you draw up a broad plan saying how much will go into which market category. Now within that category, okay, then you start selecting maximum 2 schemes. I mean, in ideal situation, 1 scheme per category is good enough. But if you go towards mid and small cap, you might want to possibly add fund manager expertise there as well. Because I know the stock selection comes into play. If you're in the large cap, probably one scheme is good enough. If you're coming to mid and small cap, then maximum, as I said, you add two schemes. So that becomes your the approach. Now, when you come down to selecting a scheme, then you start picking up a scheme saying that if I want to invest into two schemes in mid cap, do I want a passive and an active scheme combination, or do I want two active fund managers to do my job? You go and compare those two schemes that you have shortlisted with seeing what is the overlap they have, what are the performances, because performance is not only judged on a point to point basis on last 1 year. You'll have to see rolling returns on different timelines and how fund managers have functioned, or what kind of returns they've generated in different market cycles. So while there is a bull run, what kind of returns they've generated, and if there has been a market downturn, how well they've been able to curtail those downturns. So we want a marathon runner. We don't want a sprinter who does extremely well in the first 100 meters and then kind of fades out, later on. So you need to search for those schemes which have performed steady, who've
Yeah,
been functioning in different market cycles and have outperformed.
right.
So that's the combination. One or two schemes max in each category. I think your portfolio is good to go.
I'm jumping into the query. This is from Sri Kishore. He's 69 years old and his goal is wealth creation. Sri Kishore says he has invested 7 lakh rupees in the Quant Small Cap Fund Direct Growth and invested 3 lakhs in the Quant Active Fund Direct Growth. He asked, so should I be invested in these funds or should I invest in other funds for better returns in order to create a lump sum corpus for future needs? Harshvardhan, I'll come to you first. I'm not sure how long has he invested in these funds for, but let's assume it's already LTCG. So let's assume that he's been there for about a year. What do you recommend he should do? He's 69 years old, so I'm assuming he's a little more conservative than a 29, 30-year-old investor.
So, well, Samina, the good part is if you read in the question itself, he says he's 69 years old and he's looking for wealth creation. So that's a good part.
I think Harshvardhan will be more like wealth transition eventually. So I think he's honestly watching out for his family.
That's right. The idea is, if he's invested 7 lakh rupees in a small cap fund, I'm assuming he's done that research to understand what a small cap fund entails. What journey is he going to be taking when you invest in a small cap fund? It's going to be highly volatile. Now, if I'm given a personal choice, I wouldn't have designed this portfolio like this. I mean, we are more of that kind of at that kind of a stage where we say that you invest not from a trading mindset. So small caps would essentially mean very volatile, a lot of volatility. They've given exponentially good returns in the last 1 or 3 years, but that does not mean that it's going to continue like this for in the future as well. And in case there is a correction, small cap will fall in the same propensity as much as they've gone up. So my suggestion would be to have a little more balanced approach. The 10 lakh that he has, he could most certainly continue with the 3 lakh that he has in the quant active fund. However, my concerns are on the 7 lakh in the small cap. Given in conjunction with the SEBI directives, the regulator is showing some concerns with the froth that is building in mid and small caps. I think take his age into consideration, which is 69, and the allocation of 7 lakhs in small caps. I think there is a lot of room to make changes. He could possibly move towards a large and mid cap category. So I am reducing the volatility in his portfolio, saying that the 7 lakh could go into switch out of small cap, go into a category which is large and mid cap. So you still have a mid cap in your portfolio. You have quality large caps in your portfolio. So I think that approach will be better. He could have two different schemes. He could have one pure large cap fund in the form of an index fund, that owning the market that we've been trying to talk about, that you invest into, say, Nifty 50 or a Sensex 30 companies. So you'll have one portion going in there, say probably 5 lakhs going into a large cap fund and 2 lakhs going into a mid cap fund, which could be actively managed, and exit out of small cap. That will be my suggestion. Just reiterating, confirming the SEBI directives, confirming his age at 69 and allocation of entire 7 lakhs into small cap. I think this is the approach that he takes, as I suggested, between large and mid cap would be a better approach to him at this junction.
Sure. So as Samina pointed out, owning the market or owning a sector, there are some easier methods and easier, simpler ways. Surely one of them is exchange traded funds. You could simply buy exchange traded funds from the market, whether it's lump sum, preferably lump sum, because you can buy it at any point in the day. Now that will help you buy a basket, and market takes care of your investment. It's not given to a fund manager. So let me bring Mohit. Mohit, what do you think? How can ETFs help investors over a medium to longer period make money?
Look, so Murli, I think I have been of the firm belief that ETFs or passives is a category, an idea whose time has come in the markets, right? And no one can ignore that in any kind of portfolio allocation. Look, there are intrinsic benefits to investing in an ETF, whether you invest through the ETF route or the exchange route, or you invest through the index route, which is through the fund house. I think, give or less, the idea is similar that you are going into a passive strategy where there is no active fund manager. And because there is no active fund management, the cost is reduced dramatically to invest in these kind of things. And over a period of time, we have seen that as markets evolve, as markets mature, and that's an example which we have seen in the Western markets, where the US markets, if you see, 52% is now all invested in passives, right, out of the entire market in US. So similarly, as markets evolve and mature in India, you will see it becomes incrementally very difficult for active fund managers to year on year beat the market. In want of that, getting that extra alpha or generating that extra alpha by finding the fund manager who will beat the market every year, what investors do is they churn their portfolios, they rebalance their portfolios, they move in and out of schemes, which also implies a lot of cost on the portfolio. So to avoid all this, if you're happy with the averages, I think over a very, very long term, which is like a 10 to 15 year kind of a cycle, I think getting into an index fund across any category is a worthwhile thing, which investors should definitely consider in any allocation, especially for the large cap category. I honestly believe index funds or passives is something which every investor should have in the portfolio. For mid and small cap categories, yes, you can always argue that there is enough alpha available in the market and there are enough good quality fund managers who can beat the markets. So you might just want to have a combination of an active plus passive strategy, or an active plus a factor based passive strategy in those segments.
Some of the smart beta strategy returns have also been very compelling in the last few years. And just to take a piece of what Mohit said, and Murli, I think you'd agree with me, what you really need to do is build a core portfolio and a satellite portfolio. Your core portfolio can be passive, large cap funds, because they're cost effective, and the returns historically have actually beaten, passive funds have beaten active fund managers. So there's no point paying a 2% cost when you can actually get the same sort of returns through a passive strategy in the large cap space. And like Mohit also indicated, your satellite portfolio, which is what is doing the alpha generation, could be small and mid cap active fund managers and PMSs as well. So I think, Harsh, look, you want a closing thoughts? You've got 1.5, 2 minutes to very quickly tell our viewers if you agree with that strategy.
Yes, so Samina, you very well wrapped up the whole conversation that we had, made it simple for the investors, saying that, okay, you are going to be into a situation where you want that, a little extra returns, the alpha, that additional returns that we're talking about from the market. And that could be through a passive strategy or a quant or a smart beta fund. Now, what investors really need to keep in mind, I'm taking this opportunity to digress a little bit out of the topic. We've seen investors coming into the market, their expectations need to be moderated. I think right now, what worries me is that, yes, there is a lot of inflows coming into the market, and investors are experiencing good returns right now. My concern comes if you come into the equity market looking at returns, and if at all the markets were to turn around and there's a sharp correction, investors are not prepared for that. So
Right.
you need to be very careful of what the
Right.
market can do. Do not expect and assume that everything go only one way at all times.
You're right. Replace a little bit of greed with a little bit of fear. That's always a good thing. But thank you, gentlemen. Great having all of you on the show. And it was also great having you, Murli, join us on the show. With that, we're completely out of time. Thanks for watching. There's a lot more programming on the other side, so stay tuned.